Hi, morning, everyone. Thank you for joining today's Research Morning Call. I'm Wee Kwang, and today we'll be going over the Singapore Banking Monthly, the Singapore Technical Outlook, and the Singapore Weekly, as well as Netflix. Okay, so without further ado, let us begin. Okay, so for Singapore Banking Monthly, first of all, we just take a look at what happened over September, which was actually covered just last week in the strategy as well. First of all, is the on the table on the left, okay, we see the net interest margins across benchmark against the interest rates. So we see that for the third quarter itself, SIBOR and SOR are about 60 to 70 basis points lower than what was observed in the first half of 2020. So what we are expecting is that NIM in the third quarter, which will be reported over the next month, should be also slightly lower compared to the first quarter. And even though we might see some resilience for the OCBC and DBS because the second quarter might have seen a sharper drop, and then there was some repricing in deposits. However, we still think that generally, compared to the first quarter, is going to be lower, so we won't see a lot of action going on for the NIM. And then for the loans, and also on top of that, we see that for loans growth, it was quite disappointing as well. In the chart on the right hand side, you can see that based on the light blue line, actually the loans was actually went to negative, which was the first time observed since 2016. Yeah, and this was largely due to the fact that business loans actually contracted in the month of August, and consumer loans was negative. It has been negative for a while now. However, we do see some month-on-month recovery. Yeah, and so together, the net interest margins being lower, and the fact that loans probably didn't grow much as well in the third quarter, we think that net interest income will be affected in the third quarter of 2020. Okay, so just to talk about a little bit about the banking industry. So last week, MES actually came up and talked about some additional loan relief support that will be rolled out for borrowers. So it is generally applicable to individuals and SMEs. And if you take a look at the chart on the right hand side, you can see that this is across various types of loans. So you have your residential property loan, which MES actually received 26,000 applications and $20 billion worth in value. And if you take a look at the entire Singapore housing loan industry, that takes up about 11% of outstanding housing loans itself. And for unsecured credit, there was about 8,100 conversions of high interest credit card loans into lower interest. So what happened is, in Singapore, we know that credit card loans are pegged at about 26% per annum. And with this conversion into a fixed term loan, it will be dropped to 6 to 8%. So this is something you can see if you will hit the net interest income as well, and the fee income for the banks. And it's about $200 million in value, which is about 2% of all unsecured of credit card loans outstanding. Then we have other support schemes for motor vehicle loans, your hire purchase agreements, renovation loans, as well as your student loans, and for insurance as well, across general and life and health insurance, which are up to about $66 million in premiums. So for the residential property unsecured and the other loans, right, generally there is an extension of the loan moratorium. So initially, loan moratorium was expected to end at the end of December 2020, but they are extending the applications up till 30th of June for 2021. And then there's also additional, you can start this new relief program. It will try to increase your payment slowly, step by step, rather than a sudden change from 0% loan repayment until 100% of your previous pre-COVID-19 levels of repayment. So it's a slow step up, and it allows banks to start collecting a bit of money first, while allowing borrowers to ease into loan repayment, rather than suddenly you might not be able to pay off your loan, and then you immediately turn into a bad debt. So of course, this is subjected to eligibility conditions, such as you need to have a proof of income that says that during the COVID-19 period, your income was impacted by at least 25%, or there was a loss in job for the borrower itself. But what this really means is that there is an outstanding portion of loans that has potential to turn into non-performing loans, and especially for residential property, previously there were almost like 0% non-performing loans kind of stuff, but now that there is like 20 billion in value that could potentially turn into bad debt, this will be something quite unprecedented in the banking sector. Okay, so and across the three local banks, so just now what we mentioned by the MES was all the outstanding loans for across the financial institutions in Singapore. But if you take a look at just across the three banks in Singapore, we have DBS have about $18.3 billion in value under loan moratorium, which is about 5% of their loan book. OCBC and UOB have slightly higher, about 27 billion for OCBC, 10% of their loan book, and UOB is about 16% of their loan book, about $45 billion in value. If you just take it at the loan, but I just did a calculation basically. And we want to note that actually OCBC and UOB have higher exposure in moratorium relief because they have a higher proportion of their debt that is exposed to the Malaysian market. So we know that for the Malaysian market, loan moratorium is actually in auto opt-in scheme. So all their loans will automatically be opted into loan moratorium unless the borrower opt out of it. So unless they want to pay their loan off even during the COVID-19 period. And so what we see, because the loan moratorium for Malaysia has actually tapered off it has already been cut off as of end September. This is something that we can take a look whether it will be able to taper off properly in the third quarter when the banks announce their results. So the upcoming quarter's result is very important for us to understand how big of an impact the loan moratorium from Malaysia has actually impacted the local banks. Okay, so if we are moving past the banking industry, we take a look at the financials, which is SGX itself. We see that for the first quarter of 2021, the table on the top left, you can see that for SDAV itself, for the entire quarter, it was up about 16% year on year. And for derivatives volume, just based on some of the equity derivative products at the table at the bottom, we see that derivatives actually benefited in the first quarter as well. So what we are seeing is that for the first quarter of 2021, SGX is likely to see both securities and derivatives to kind of outperform year on year by about 10 to 15%. And alongside their contribution from their acquisitions, which is Scientific Beta and BitFX, that will help contribute to revenues. We think that in the first quarter of 2021, SGX will see about a 10% increase in earnings. Okay, so generally for our investment action, because of the low interest rates and low loans growth to impact the poor net interest income, and also only just a slight recovery in non-interest income. Of course, we are expecting income to recover from the second quarter levels, but we don't think that it will reach pre-COVID-19 levels anytime soon. The heightened allowances to combat the economic fallout from COVID-19 will also be likely to stay according to guidance until end of 2021. And the cap in dividends will also impact them, make them less attractive in terms of dividend yield as compared to other sectors such as the REIT sector. So we think that we are still maintaining a very neutral stance on the banking industry. However, of course, like I mentioned, the re-rating catalyst will come when there is a better than expected credit profile of the borrowers once all the moratorium relief schemes end in Singapore. So right now, first cut, we already see that Malaysia has cut off their loan moratorium. So we will only know the impact in the third quarter results. But moving forward, if Singapore cuts their loan moratorium and we see a lot of borrowers start paying back their loans as well, this will help to lift some of the pressure on allowances before the end of financial year 2021. Yep, and that's it from me. I'll now hand the time over to Jin Rong, who will be talking about Netflix.
Okay, hi everyone. Thank you, Guang. So now I'll be talking about Netflix. Next slide, please. Okay, so Netflix actually needs no introduction. So they offer a monthly streaming subscription. So we look at this streaming revenue, it derives a majority of around 47% from the US and Canada region. So the region also contains its largest subscriber base and delivers the highest average revenue per user, or what we call ARPU. Okay, its second largest market is Europe, Middle East and Africa at 31% of revenue. This is followed by Latin America and Asia Pacific at around 13% and 9% respectively. So we believe that its international expansion will actually spur its next stage of growth. So if you look at the paid subscriber in this international region, it has grown at a much faster pace over the last 5 years at a CAGR of 42%. So these when I refer to international region, they are regions that is outside of US and Canada. So the growth rate actually towers in comparison to the US and Canada's region, which stands at around 12%. And this strength is able to more than offset the lower ARPU of 30 to 70% in an international region. So why this international region have a lower ARPU is because Netflix have a lower price strategy in those areas in order to expand their market share and to attract subscribers. And as of 4Q 2019, revenue from international region overtook that of the US and Canada. And as of the last quarter, it accounted for more than half of its revenue at around 53%. So in a way, we believe that this testifies to the success of Netflix targeted strategy of streaming regional content and also partnering regional channel providers to distribute their content. So in a way, we believe this strategy of having, in terms of the APAC region, which is its highest growth market, they have a strategy of having a lower price mobile-only subscription. So in a way, we believe that this will continue to attract subscribers because it has been very popular in India. Okay, it has managed to draw a lot of subscribers, and we foresee similar success in replication to other APAC countries with similar characteristics. So similar characteristics are referred to like lower income and also higher mobile streaming usage. So Netflix also have a large pipeline of fresh and new content in order to retain and drive our subscription. If you look at its content library, it has 459 brand new 2020 releases. So these are very, very new content, only released in 2020. And it's almost double that of Prime Video and also dwarfing its other competitors. If you look at this content, almost all of it, around 98% is exclusive. Exclusive means that this content can only be accessed from Netflix itself. Therefore, I believe that this large pool of fresh content is actually well positioned to retain and drive subscription. They also anticipate that the total number of its originals for 2021 will still be higher than 2020. So this suggests that delay in content production caused by COVID-19 is relatively short-lived, and I expect that it should have a minimal impact on its churn rate moving forward. Okay, so for the SVOD market, so SVOD stands for subscription video on demand. So for this market, Netflix has a huge lead in terms of subscriber base over its competitors. So even though Netflix will continue to face competition in this market is not a zero-sum game. So what I mean by this is that consumers, they are able to subscribe to different streaming services for differentiated content at a reasonable pricing. So we can see from the table that Netflix actually has a strong lead over its global competitors, with around 62% more subscribers than the second largest streaming player, which is China's IQE. So I believe that in this way, by investing in a localized and differentiated content, Netflix has been able to add subscribers, okay, despite seeing new entrants such as Apple TV and Disney+. Okay, a main key risk for Netflix will be its dependence on external providers for content, okay, because we know that it licensed some streaming rights from external content providers. So in a way, any loss of licensing agreement with key content providers will limit its content library. So we see this when Disney decided to launch its own streaming service, Disney+. They actually ended their distribution agreement with Netflix. And this causes Netflix to lose access to several popular content, such as Toy Story 4 and also the sequel to Frozen, which are very popular series. So despite this steady shift away from licensed content over the years, its percentage of a licensed content still remains quite high at around 58%. So another key risk will be its constant need for differentiated content in order to attract subscribers. So Netflix constantly has to invest in production of differentiated content, which will continue to weigh on its free cash flow in the next few years. Currently, we think that is less of a concern because its paid subscribers is able to grow faster than its content spending. Okay, but moving forward, do look out for this space because risk may start to surface if the reverse occurs, because it just means that their investment in content production is becoming in a way less efficient per se. Okay, and now for the TA portion.
All right, thank you, Chinrong. So just do a very quick summary. So last Friday we did issue a trading note on Netflix itself. So for Netflix, I think the overall trend is very on a strong bullish side. Okay, so as you can see that I have a bullish flag pattern that I plotted it. So on the safe side, I issued a buy limit on the support zone one, which is near 458.40. But however, I think there is the pullback is going to be very short because prices is still support above the $500 region. And then I think that there's a chance that it will break up on the upside above the wave one chip which you can see. Another thing is that if you look throughout the cycle phase of wave 3 and wave 4 has been completed. So currently we are on the sub wave 1 of the primary phase. So if the stock is going to make a bullish run, I think it's going to be a very strong extended up. Extended wave 5. Okay, so also to note, price is still trending above 250 weeks moving average. So cover me for the typo because it's a weekly chart. All right, so that's all for the Netflix. So next slide, I will share about the technical outlook for straight time index. So for STI, the next slide. Thank you. So I got two analysis. So for the start, I think okay. So if you can see my mouse over here. All right. So this chart is completely about on the is based on past few webinars ago, which I state that there's a tendency that price is going to test the lower zone. But however, I think price has already broken out of the downward sloping line, which on the same slide is a falling wedge as well. Okay, so it's a low it's like a enlarged falling wedge. Okay, but if you look at it, price has already formed an evening star, but today I think price has already is on the upside. Price is still hovering above the 2,500 region. So therefore, but it's still yet to test the invalidation zone for wave 3. So if price do as a bit some strong reversal in the midweek, I mean on Wednesday or on Thursday, then we believe that there might be a correction down to the lower bound of the support zone 1 before a rebound. All right, like what I mentioned on the slide, the wave 3, the sub wave 3 is more likely to be invalidated soon. Okay, so should price reject, and then price, like I mentioned, price is going to hit over the support zone 1 of the lower bound. All right, so the next slide, sorry. Okay, the next slide is about it's more or less like what I mentioned earlier on, but now is more of a fractal nature. So I discovered something that's interesting. Instead of a fourth wave termination over here, like what I mentioned on the previous slide and a previous past webinar, I'll take it that this is a potential double, I would say a double zigzag wave. It may not look like it, but I think or a double tree corrective wave. All right, so it means that a flat is actually a corrective flat. It should price reverse and then rebound from the support zone here in the first part, rather than an up move and then followed by a down move to this support zone. Okay, so the fractal nature, you can see from the A and B, the smaller falling wedge followed by a middle one and then followed by the larger one. So this is very interesting. Okay, first of all, the smaller falling wedge actually has a very strong up move and then followed by the middle, the mid-sized falling wedge has also a very strong up move as well. But if you look at the larger falling wedge, it has only a false breakout, and then subsequently price rejects and then go down all the way to the lower level. So there's two theories for now. All right. So the first theory is that price is going to break the immediate resistance zone, which is the wave 3 invalidation zone as well. And then price is going to test the upper resistance zone at wave Y in the midterm. So if price, and another theory is, the second theory is, which I think that is more likely to happen, is price is going to break up, false breakout, or reverse at the resistance zone, and then followed by a 5-way corrective down, and then before a rebound to form the next leg of wave Y. So all in all, we are still expecting a long-term target of 2,900 to 3,000 region. Okay. So next one will be Hang Seng Index. So the reason why I put in Hang Seng, because I also discovered the same thing. All right, there's a potential triple zigzag on the larger time frame, which is the weekly time frame. So if you look at here, look over here, is we have an extended wave 5. So some may dispute that this wave theory is wrong. Is not going to be very strong, or is totally wrong, because wave 3 it shouldn't be the shortest. It should be longer. But after some backtesting, after some intense research, after some intense correlation with other data, I finally come out with this instead of a 1, 2, 3, 4, or 5. So this one will be extended wave 5, which is still matched with the rules. I think wave 3, if you measure it, wave 1 is shortest, and then wave 5 is the is the extended. So another theory is that should any of the motive wave is extended, the rest of the two motive waves will likely be around the same size. So if you look at this, I think wave 3 is slightly bigger, but it still match the theory of equal size or same size. All right. So where extended wave 5 occurs, the next correction will be very deep and strong correction on the downside. Okay. So you look at the downside. I think the downside channel has really propagate a triple zigzag wave, because if it's a double zigzag, and then this will actually be a strong bullish upside, but you can see that it's forming a expanded triangle, a broadening for rising wedge, which is going to be a very strong bearish move through wave E with or double X is going to be fulfilled. And then there's a correction down to wave Z, and then therefore there's a rebound on the upside as well. All right, so the next slide. Okay, so sorry. So the next slide is the Hang Seng Index, the daily chart. Okay, so daily chart also shows same analysis like what I propagate in the weekly chart. So, but if you zoom in, the question is Hang Seng going to break this immediate resistance zone today? If there is, then I think that this support zone 1 will be a very strong course, and then prices will likely to test 2550, 25,500 before a slight pullback, and then followed by another 3 or 5 sub-wave upside to resistance zone 1 or 2 to form double X, and then correction to form double Y. But however, there remains a chance that if this level at 2550 or lower is being rejected, then we'll see that price will immediately correct itself, break support zone 1, go to support zone 2, and then followed by a strong rebound, and then therefore after there is after. So for the Asian market, including Nikkei index, I didn't prepare Nikkei index, but what I can see that the Asian market is exhibiting some sort of like neutral zone, like whether is it going up or going down. So it is very confusing for now. All right. So the last one which I'll be sharing is the Hang Seng Tech Index. It debuted in late July, early August. So therefore I use the 4-hour chart. But the 4-hour chart, you can see that despite on the strong upside on July since debut, price actually has corrected itself and then fails to clear above 8,000 in late August, and then thereafter price make a 3-way up and then a 2-way downside. So we think that there is a WXY wave, means that in other words is a 335 corrective wave before the start of an impulse wave 1. So with that, I end off my slide. I pass on my slide to Paul. Paul, thank you.
Thanks, Viren. Move on to our usual Singapore weekly update. Next slide. Okay, I'll start off with the macro highlights for Singapore. We got the retail sales number. So retail sales excluding motor vehicles, we exclude motor vehicles because motor vehicles is very volatile. So just to get the underlying trend, that is why we use we exclude motor vehicle sales. So for August, actually the number was more disappointing than July. August retail sales in Singapore fell 8%, slightly more than even the July numbers. Month on month is improving, but year on year is still rather weak. The good number came up. The great number actually came up from supermarket sales. Supermarket sales was up almost 22%. Just to give you some context, pre-COVID-19 supermarket sales in Singapore was only trending around 2%. So you can see right now supermarket sales is growing like 10 times faster than what they previously did. And in July was even faster. So even though there's a moderation, the growth in supermarket sales in Singapore is still very, very robust. The next data point we got is taxi. So in terms of the kilometers traveled by an average taxi, is actually up month on month, so that's good. But year on year, it's still down, so 20%. So we got to taper our expectations in terms of the kind of revenue coming up from taxi. Although the rental the reduction in rental relief will obviously be very good. And the taxi fee was still down, but market share for Comfort was maintained at 60. In terms of real numbers, the amount of riders, the ridership for SBS Transfit, it improved month on month also, but again year on year is still quite a very big number. It's almost down 41%, and for the third quarter is down 45%. So the traffic in real is running at half its usual level. Later this week, we're going to have the MAS Monetary Policy Statement, the MPS. This usually happens in April and October, every 6 months. The last one we had, the MAS just said there's zero appreciation and no change in anything. So for the upcoming one in October, I think there won't be any change. It will be like a yawn and nothing important is going to happen. I think the last time we had in 2016 a zero appreciation in the exchange rate. The next 1.5 years, MAS can just do nothing. And one of the reasons is that their core CPI or core inflation forecast is -1 to 0. And so far the August number is just within their guidance. So there's no reason for them to change anything on their monetary policy. In terms of Singapore property, we attended over the weekend. I think maybe a number of you may have also attended PropNext at this virtual property show. The main highlight for us, in terms of the macro, there were a lot of property launches and a lot of micro details. But in terms of the more macro and holistic thing, was that the main message we got is that the current property cycle is rising. It will be a gradual rise, but it will be more sustainable. The reason why it's more sustainable is that you don't see any surge in prices, similar to the previous cycles where we had almost 40 to even 60% rise in prices. We'll show you a chart later. The reason why growth will be the rise in prices will be more sustainable is due to the implementation of TDSR in June 2013. Another sign why there's less speculative demand is if you look at the level of sub-sales. In 2008, it used to run as high as 10% of all property sales of all new projects, but right now it's less than 1%. The one thing good on the demand supply picture is that the developers inventory is actually coming off. So now we are more at the average levels of 3 years, and there is demand coming from HDB upgraders. I will show you why later. Another piece of news that came out for property developers was the extension of the additional buyer stamp duty and qualifying cert. Just to refresh everyone, the qualifying cert is the additional duties that they will impose if the development is owned by a foreigner. But I think the recent policy in February meant that a lot of the listed developers, so long as they have more than 50% ownership, they don't have to worry about this qualifying cert payment. But the ABSD still stands, and the ABSD is even more punitive. ABSD is that if you do not sell all property units within 5 years of purchasing the land, and this means even if you have 1 unit left, you have to pay additional 25% on the land, an additional 25% duty on the land cost. So this is a huge penalty. But anyway, this is extended for another 6 months, so you can consider this as a day 2 problem to worry. In terms of the US, we wanted to have a quick look at what the polls are. The presidential polls in the US is not a nationwide poll. You can assume there are like 50 different elections happening, because 50 states will do elections. So it's not one national election. You can assume that there's 50 elections underway on the 3rd of November. But so far, all the battleground state polls still favor Biden. In terms of our tactical views, we are cautious. I think the reopening of in Singapore of all the activities is underway, but I think we will only see a more meaningful improvement in economic activity for Singapore in the 4th quarter. I think we think the 3rd quarter results will be still weak. It'll be like a damp squid. I mean, like damp squid. I mean, we won't be anything happening much. I think if you look at all the year-on-year numbers for all the various sectors, it's still very weak. The other thing to note is that the pandemic globally is still at record levels, and in a way, you're going to see even higher demand for rubber gloves. The US stimulus, the much talked about, is still up in the air. There's a new proposal, but there's a lot of politics behind it because the US Senate is focused on this Supreme Court nominee. In terms of the events coming up, we will have our GDP 3rd quarter advanced numbers, the MAS, and also some of the export numbers. Below is just for you to read. I mean, these are some of the events, the listed company events happening. For this week, we're going to have Starburst. Then we will have Fortress Minerals and IX. Fortress Minerals and IX is still not on poems yet, so we will have to wait for it. There's also a webinar, but this is only TRs only, regarding Lipo Mall's trust rights issue after the recent acquisition. Okay, so these are the COVID daily cases globally, and the numbers are pretty grim. If you eyeball the blue line, this is the global infection rates on a daily basis. So you can see it's hitting about 300,000. But if you take, because this is a moving average, if you take the latest number, I think the blue line will probably hit the 350,000. So the pandemic is now like 2 or 3 times higher, or even double going to hit like 50% higher than just a couple of months ago. And you can see one of the reasons is Europe is still escalating, and in US, after the second wave, it seems to be coming back up again. So we are globally struggling to contain this pandemic. I think the two key points from this is that if this keeps on rising, then there will be a slowdown in global economic momentum, number one. And if you assume the blue line is like global demand for rubber gloves, then of course the demand for gloves will remain very strong. Okay, so this is the cases in Europe. So in Europe, they're not experiencing just a second wave. It's more like a tsunami. I think if you look at the red line, especially, these are the number of new cases in UK. I mean, it's quite a mind-boggling number. After their first wave, this is no longer a second wave. It is like 3 times more than the first time they had it in April. Again, I'm not really clear why the numbers just spiked so high. But from what I understand, during summer, what the UK government did was they actually subsidized everyone if they go to restaurants and pubs, if I'm not mistaken. So they actually subsidized half of your bill. So obviously everyone just went to restaurants and pubs during the summer season, and that may have been a contribution. But again, I'm not very clear why. But the thing is, these are not good numbers, and I think they will be announcing another round of lockdowns in the UK. The reason why UK is important for us is that from the Listo side is that, as you know, some of our developers have property projects in the UK, number one, and some of the companies have student dorms in the UK, like someone like SPH. So obviously it's not good for these companies that have operations out of the UK. The good news again is Singapore. So our community cases is 1 or sometimes 0. I think sometimes because if you round it up, it's probably like point something. It's not even 1. So that's good, and you can expect more and more easing of group activities and restrictions in Singapore. So this is good for our economy. Okay, this is going to be hard to read, so don't try to read. We were just trying to cram all the government announcements. But anyway, the main takeaway that we wanted to share is that if you look on the table on the right, so those on the left usually, we had phase 1, phase 2, those in red. But in the 3rd quarter, there wasn't really much of easing. mainly about a lot of fast lane travel between Singapore and other countries. But from October onwards, you can say that the authorities are much more aggressive in opening up. So in October, we are going to have MICE events, basically conventions. I think the first one will be in the end of this month in October. There'll be some energy conference out of Marina Bay. So we are beginning to open up. And cinemas also now you can admit up to 150 packs, wedding receptions, religious events up to 100 and so forth. And even we have cruise to nowhere. So as you can see, only in fourth quarter, we will see economic activity start to pick up pace. So third quarter, there was still a lot of restrictions. I think the authorities has also mentioned that they will be coming up, they will increase the group gathering limit from 5. Phase 3 roadmap will also be announced. So we can say that fourth quarter, the improvement will be better in the fourth quarter rather than so far what we've seen in the third quarter. Okay, this is just retail sales. So rather than give you a monthly numbers, we just look at it from a quarterly, since this will be roughly how the results will be. So if you look at just the third quarter, so far retail sales, we only got July and August, so we don't have September. So this is not the complete picture of retail sales, but you can see that supermarket sales remain very robust. If you just look at the fourth quarter 19 on the far left, the red bar, supermarket sales used to be like 2%. Then it jumped to 20% first quarter. Then of course we had the circuit breaker, so it jumped to 60. So even now at 25, this is like 10 times more than what they usually do in the fourth quarter. So supermarket sales are still very, very robust in Singapore at least. Okay, this is just, we wanted to measure, LTA announces this every month. So we wanted to measure how is the amount of travel done by a typical taxi driver. So we can see that it is improving, but again, on a year-on-year basis, it is still down about 20%. But at least month-on-month, we do get a V shape. Next slide. Okay, in terms of number of people traveling on the trains, you can see that we hit a low in May during circuit breaker, but things have started to pick up. It's tripled to about 700,000. But again, when you compare to a year ago, about 1.2 million people traveling a month on SBS Transit Rail, you can see that this is still a big 40% decline. Okay, I'll just have 3 slides on property since I just attended the virtual property briefing. The message here is that, okay, this is the Singapore residential price cycle. So in red, it's during .com, you can see that the prices declined about 11%. Then we had this big rally before the global financial crisis of 45%. Then again, the GFC in red now at the top, you can see we declined 25%. Then we had this big rally 60%. So we're having this boom bust cycle. But I think this time around the message was, I think post TDSR, I think prices will rise, but in a very gradual manner. So after TDSR was announced, prices started to drop about 12%. But since the low in 2017, it started to climb, but very gradual. I think 13% over 2-3 years, rather than the usual 60-40. So the message here is just that it will be a gradual and sustainable rise in prices. There's no boom and bust. Okay, next slide. Okay, this is basically, so when we now look at the property in terms of the supply and then the demand, so if you just look at the amount of supply, so these are unsold. It doesn't mean they launched and they couldn't sell, but some of them they haven't actually launched. So these are whatever inventory, some are still being developed, but maybe they are waiting for approval or license to sell. But they already got the approval. So you can assume this is just inventory. Sorry, just such a long answer. But so the amount of inventory we had was about 38,000 at the peak. But since then, in 2019, since then it has continued to come down. So the third quarter 20 estimates about 25,000. And more important is this red line. So this is basically the amount of inventory that a developer has compared to what they sold 12 months. So you can see right now the inventory by developers is probably below the average 3 years, and it's probably about 2.5, 2.8 times. So it's a much more healthier levels and back to average levels. It's not unusually low or unusually high. So supply is normalized right now. Next slide. But demand seems to be picking up. One of the reasons is the HDB upgraders. So this is basically the HDB resale price index. HDB prices had a major rally from 2005 to 13, it basically doubled the HDB price. But since then, it has slid, and then only the last 1 year we have seen resale price for HDB start to recover, although modestly 2%. But we're beginning to see a pickup in prices, namely for 2 or 3 reasons. Firstly, you can see the second bullet point. September last year, I think the government announced a very generous housing grant, as much as 160,000 if you're a first time. Doesn't mean everyone get it, but those who qualify, you get a 160,000 grant for resale. And then there's also the delay in BTO by 6 to 9 months due to COVID. So as a result, those who cannot wait, what they do is they have to go into the resale market. And secondly, there'll be almost 80,000 units of HDB available to be sold because they've already met their 5-year minimum occupancy period. So 2022, the next 2-3 years, there's units available to sell. So this will be another driver for HDB upgraders, and this will help the mass market private residential units demand. Right? Okay, this will be my final slide. So we just wanted to have a quick check on what the polls are doing. I know this is a bit of this chart is a bit complicated, but so let me run through it with you slowly. So the table on the left, the 2016 election, Trump wins. So these are basically the results in 2016. So if you look at the box, in 2016, let's say we take Pennsylvania. So in 2016, Trump only won by a very slim margin, 0.7%. Michigan, he only won by a very slim margin of 0.3%. But so if you look at what the polls were saying, so the polls, let's say we take Michigan, probably that was the worst poll. So in let's say we take Pennsylvania, So in Pennsylvania, the polls were showing that Trump will lose by 2 percentage points, but he actually won by 0.7. So the difference is there was a swing of 2.6. So you can see that the polls were basically wrong for roughly 2.6%. Likewise for Michigan, he was supposed to win almost 3%, but he won 0.3. So the difference is about 3%. So if you look at the current polls right now, Biden is still leading. I think like Pennsylvania, these are the battleground states in the sense that these are states where they can swing. Sometimes they swing to Republicans, sometimes they swing to Democrat. So, but you can see that in Pennsylvania, Trump has a big lead, about 7%. So even though you don't believe in polls, but the margin is just too huge to be wrong. So about 7%, Michigan he'll win. So in a way, the states that Trump won in 2016, the Pennsylvania, Michigan, Wisconsin, these are the states very high chance that Biden will swing to Biden. And don't forget that in 2016, Hillary lost about 39 seats. So all these seats will be very meaningful for Biden to win because the difference was 39. The big states like Florida, the first one, it's still touch and go whether Biden will win, although the polls still show that he will win. And the other less clear would be the North Carolina. So these are still within 3%. But in general, we can still say that Biden will be the most likely winner. Again, the reason why we want to we continue to just have a look at the polls is because your Biden win will be, as you can recall, Biden win will be positive for Asian assets and also Asian currencies. So anyway, this will be my last slide. We will take any questions and for now. Yeah, thank you.
Okay, move on to Q&A. I think currently the first question is for myself. The question is, what is the reason for DBS to rise in price while OCBC and UOB seem to be the laggards? I'm assuming among just between the three, the banking stocks. Yeah, just give me a moment. Okay. So, in terms of I think price movement wise, I think most of the investors are more upbeat about DBS in terms of their earnings recovery as compared to OCBC and UOB. I think OCBC has always been battered by higher allowances, especially for the oil and gas sector. Even until second quarter itself, we still see that there were some allowances taken for the oil and gas industry, although they just keep saying that it's a cleanup of the loan book for oil and gas. And for UOB wise, I think generally they are just a bit more conservative in their estimates. So people are expecting them to they seem to be more, how do I put it, not as optimistic as compared to the other two banks in terms of a recovery. So I think people are just a bit more hesitant to invest into UOB. Whereas DBS, I think, apart from all the slowdown in net interest margins and non-interest income, what we know from what they have released was that they have these unrealized securities. They are basically their war chest to tide over this COVID-19 period is very large. So I think people are banking on the fact that they will be a lot more resilient if it worsens, and when they recover, they'll be able to take better. They'll be able to take more opportunities to recover as well during this period, because either they can sell off their investment securities to realize some gains. Otherwise, I think if you talk about capital markets activity resuming, right, DBS having a stronger investment banking arm and corporate banking arm will be able to make better use of, will be able to capitalize on these opportunities out there. That's why you see that on the stock exchange, usually DBS always move. And also historically, just by looking at DBS price movements, you see that generally it is more volatile in the sense it swings more compared to OCBC and UOB. Yep. So hand the time over to, I think, maybe Wei Ren for some TA questions.
Okay, thank you, Wei Guang. So I think there's quite a number of them. So I'll read through a question and I'll do a one shot. I'll do everything that I pass back to my colleague. All right. So just give me a moment. Okay, so just having shared my screen. So if you can see my screen, just give me a thumbs up or hands up, and I'll carry on. So there's a question on SGX and then Sheng Siong. So for SGX, I'm still very bullish, strong bullish, and then why is it? Because there's a very strong impulse upside, and then there's a pennant followed by that, and then as long as price stay within $8.89 and $9 region, above $9, and this support, immediate support at $8.89, I think price is going to be on a strong upside. Furthermore, if you can see that the 50-day moving average is going to cross upward, and if it cross above the in the near term, if it cross above the 200-day moving average, then we can confirm that the bullish upside will be kind of like a confirmed uptrend. All right, because it's actually a very strong bullish crossover. All right. Target price is still what I've mentioned in my report. Otherwise, if there's a delay or there is changes, then I'll update accordingly. All right, the next one is Sheng Siong. So Sheng Siong, I think it will be strong bearish. The price target to accumulate is I'm still keeping at this level. Between $1.52 to $1.56. All right. Reason is because this continuation pattern of a bearish pattern. This bearish pattern. If you don't look at the wave count, if you look at that, let me see. If you look at that, extension, we have completed wave 3 already. So this complex corrective is actually wave 4. So expect some consolidation, but won't be put unless price actually break up $1.72. Then we can confirm that the upside is confirmed. Otherwise, I think price is going to accumulate, have a strong upside rebound at between this zone at $1.52 to $1.56. All right. So next one, I think kitchen culture. Okay. Okay. So kitchen culture just now. Let me see where is it. Yeah, I think it is. Okay. So kitchen culture, I think is overall very strong bearish upside. The upside is very much of a slow momentum, so therefore I think it's a corrective wave. But immediate upside there is, but price because after it break off the falling wedge, there's a bullish pattern today. But we're going to see further upside. It depends on 1.41. 0.141 is it will be broken in the next few days or not. So if price revert lower, reject this immediate resistance line and then break 0.129, then we can very well see some more downside. Means that this corrective upside is completed. Then we are seeing a resumption of the downside as well. But otherwise, I think price is going to break 1.41, 0.141, then The next level at 0.167 will be the midterm testing level, and then once it's break, then we'll see most likely price is going to terminate at 0.200 region based on the extension level. And then, yep, 0.2 to 0.215 region. All right. So that's for kitchen culture. And then the next one is Wilma Maple Tree Industrial. So I'm going to do, because of time constraint, I'm going to do two stocks for now. So let's take a look at Wilma. So Wilma has a very strong upside. It broke off the resistance I mentioned at $4.53. Price, but however, price did has cleared up the gap and then swiftly rejected. Price slowly aging up, but the momentum is sluggish. So therefore, I think any upside will face a further resistance at $4.79 and even $4.87. Wilma, therefore, in the short term, will be very neutral. Okay, the next one is Maple Tree Industrial. So Maple Tree Industrial upside is still on. Okay, first of all is the panel-like pattern, impulse, corrective, impulse, and then a very strong impulse. So are we seeing we'll be seeing a further upside of the fifth wave that I mentioned in my report previously. So expect price test $3.50 and then $3.70 thereafter for Maple Tree Industrial, and then for Maple Tree Lock. Okay, so I'm going to do Maple Tree Lock before that, and then Maple Tree Lock slightly sluggish, but I expect a further correction before a rebound thereafter. As for now, short term, Maple Tree is going for a very what do you call it, neutral stance. Okay, so next one will be Yangzijiang. So Yangzijiang has been going on a very strong corrective flat pattern. So Yangzijiang consolidated over here. If there is a bullish upside, in order to confirm a bullish upside, you need to break the resistance zone at $1.01 and then subsequent 1.02 region. All right, this level will need to be broken to confirm the upside. All right, and then next thing is pennant, and then bullish candle for today. Otherwise, I think price is going to remain very consolidation over here. Yangzijiang so far, nothing much for now. All right, but I'm still hopeful for a very midterm target of 1.135 to 1.165 before it goes so down, because you look is actually a very strong WXY. And then there is a double tree corrective pattern going on for Yangzijiang. Okay. Okay, Gili is. I think Gili compared to BYD, I think BYD is much more stronger, but Gili is still going on strong corrective pattern. Strong bullish candle. I think look like PSNI, but it's not just a normal candle, not a tweezer bottom as well. Upside is there, but we need to see the price going to break off the falling wedge or not. Otherwise, I think price is going to face strong half resistance over here at this level at $17.50 to $17.92. Okay, so I think price okay. Just take it that price is going to test this resistance zone in the midterm. All right. Franken, I'll do it. Okay, Franken. Franken make an unexpected upside, but if this upside if price is due today, this week is going to remain below 38.2% Fibonacci retracement, then I think price is going to consolidate further before the upside. Price I mentioned last week, I think this Franken is very much in the range after it broke off the uptrend line. Any upside will face strong resistance at 1.14 to 1.16, and then as I mentioned the previous webinar, I think this support zone is tested multiple times, so therefore it's kind of weakened now. So if price is going to face some tough resistance, then we will see price heading further downside to 0.81 in the long term. All right. So otherwise, if this is broken, then 1.26 with the next resistance level to be tested. All right. Jaffa, same thing. I think today there's a bearish candle came down. I think mentioned last week that there's a channel or wedge-like channel. It's broken up, but price is going to face some tough resistance over here. Expect some pullback after it break out. So let's see if this 0.61 and 0.6 will be holding well or not if there's a pullback. Otherwise, look out for any break to the upside in this week. Okay. So one thing, volume wise, I can't assess the volume now. There's some problem with my trading view, but it still remain sluggish. Upside reversal possible. It means that because first of all there's a pattern over here already. It has broken out, so I think we will expect some pullback before rebound. Rebound, you can expect some reversal at resistance at 0.440. All right, that's for one thing. UG Healthcare after a stock split. UG Health, I think not much data. The previous one, the 41K is not going to be strong. Okay, UG Health. If you look at the data, I think there's a pattern, strong pattern. I think working the upside maybe after the stock split. All right, so this is a strong impulse even after the stock split, and then there's a pattern, and then we will seeing a further upside. Okay.
Jeffrey, can you help answer the Yoma question? Well, give Viren a bit of break.
Okay.
Jeffrey, can you answer the Yoma? And then the second question on the market, Junong, can you just add before I comment?
Okay, maybe I'll just start with the Yoma question. The question is, any view why Yoma is so far away from the indicated target price, and will the current price go down further? So in terms of Yoma's target price, it has remained unchanged since our initiation in June. The reason why Yoma's stock price fell further is largely due to the resurgence of COVID-19 cases, which is currently and also unfortunately at its all-time high since its breakout in September. Myanmar is currently in its partial lockdown stage, so you can imagine like people can still go out, but there's restriction, a bit like how it is in Singapore. And then like only one person can go to a supermarket, and then as in like there are still like other restrictions also. We do think that Yoma's stock price is depressed in view of the growth prospects we see in the company and in Myanmar's economy. Myanmar's GDP is still expected to see positive growth this year and also recover to 6% in 2021. Its property and financial services segment is expected to hold up during this period of time. And maybe just another point to note as well, Ayala is also expected to invest another $46 million USD at 45 cents per share, which is actually close to that of our target price. Yeah, whether or not it will be going down further will depend on this COVID-19 situation, if it can be controlled. As in like amidst this lockdown, we do think that Myanmar will actually try to control this COVID-19 situation. Yeah, so I hope that provides some color. Yeah, that's all from me.
Yeah, I think for Yoma, to get back some price momentum, this COVID-19 situation has to improve now, number one. Then we can see them relaunch the property projects. Then their KFC outlets, which is like half open now, can reopen. Then you can see some earnings momentum. So until then, this COVID is just going to derail any earnings momentum expected from this company for now. But longer term, we still like it a lot. Junong, can you help out on the second question before I come in? On the market.
Sure. Yeah, sure. So the next question is on what's the probability of a stock market retreating to a much low due to several negative factors. So personally, I believe that we may not be actually seeing the much low price level again, especially when it comes on the back of, in terms of the US, we have the Fed's whatever it takes stance. And in terms of a resurgence in the COVID case, I do not foresee that we will have a nationwide lockdown again, because that will be too damaging economically. So probably there will be some restriction, mobility restriction here and there, but ultimately there won't be a full lockdown. So the economy will continue to progress. It's just it may affect the pace of it. And also in terms of after the election, I'm generally still quite bullish going into 2021. Rationale is that after the election, after the election, there may be more fiscal stimulus as proposed by both sides. They want to pump more spending in terms of infrastructure. Yeah, so this and also next year we may be looking in terms of mass production of a vaccine. Of course, targeted timeline is in terms of early to mid 2021. So in a way, all this will definitely boost sentiments moving forward in terms of economic recovery. So I personally, based on all these factors, I do not foresee that we will reach the much low level again. Yeah, this is my take on this.
In terms of for the Singapore market, on this same question, will we hit the March low? We think it's unlikely. The first reason is the economy. In March there was a circuit breaker. The whole economy was kind of paralyzed on standstill. So number one, so things, as you can see, the authorities are beginning to open up more and more. So we've probably gone the worst in terms of the economic momentum. I mean, we bottom out, I guess. The second thing is for the STI, 40% of the index is the banks. So the question is, have the banks bottom? So we think that the banks have definitely bottom. They've already provided 2 years of provisioning, and we think it's a bit excessive, number one. But the upside will be a bit slow because there isn't much of there's no momentum in terms of loans growth. Loans growth is like we can say is less than 1. Number 2. Then number 3, interest margins is going to be under pressure because of the low interest rates. Then number 4, fee income will still grow, but maybe low single digit. So we definitely off the lows because of the provisioning and economic activity. But for any major rally, it will take some time. I think we need to clear this provisioning. The big call, like we mentioned, will be once the banks come out and tell us that maybe they're over-provided, then we know that the banks can at least rally from these levels. But until then, it will be a bit sluggish for the banks. But definitely not the lows, because economic, we really seen the V-shaped rebound in a lot of sectors. So things are improving, but just a year on year is still weak. Natalie, there's a question for you.
Okay, I'll take the question on Fraser's first. So the question is, the share price has dropped due to a very confusing rights issue. So some color on that. So first of all, we think that the price drop is largely due to the equity fundraising, which is from the placement and the preferential offering for the acquisition of the remaining 63.1% stake in ARF. So because this equity fundraising is done at a discount, and the price is about $2.35 and $2.34 for the private placement and preferential offering respectively. So it is done at a discount to the prior or prevailing market price. So that was part of the reason for the fall in the price. A second reason is also because it's actually a relatively large rather large issue of equity. Yeah. So however, this discount, or rather this lower trading price, doesn't affect or doesn't change our investment thesis or outlook on FCT. Yeah, so for those of you, just let me know if you need me to explain a little bit more about the way the mechanics for the rights issue will go down. But yeah, so in a nutshell, right, price fell because of the EFR, equity fundraising, but doesn't affect our outlook. I'll take one more question on, I think I saw one on CMT and CCT. If you still want to get on board the merger train, which share should we purchase now and at what price? So for both of these counters, I think that right now, because the merger has already been approved and the price will more or less be crystallized, so there should be no difference already in terms of which to buy. But probably if you were to buy CMT, it would be a bit more convenient for you because you will not run the risk of getting odd lots. Yeah. So our target price for both counters, our new target price for the merged entity, we haven't come up with that yet, but we know that it will be higher than the $2.33 that was previously for CMT's target price. Okay, I also one more question on Suntec REIT's recent acquisition of the London property. if I can find the question right now. Okay, so the question is, can you comment on recent news about Suntec's potential acquisition on the mixed development property in London? Any potential upside on target price? So first of all, we don't have any target price on Suntec because we have no coverage of Suntec. However, just some points to note about this acquisition. It seems to be done at a slight discount to the pre-COVID price, so that is a mild positive. The acquisition is accretive. I think the MPI yield after management fees will be about 4.5%, and also the accretion, the DPU accretion will be around 2% to 4%, depending on the mix of debt and equity financing that will be employed. So overall, because this is a relatively active acquisition, and also the asset is located in the west end of London, which is relatively low vacancy, and also relatively high rents area in London. So the management believes that this will be a very accretive transaction for unit holders. However, we just want to caution about one thing is that because there's a chance that the gearing will spike up above 42%, because in their pro forma, Suntec actually said that, give the analogy of using 100% debt for the pro forma calculations. So in any case, even if they were to use 100% debt, we do expect them to actually gear down over time, be it through buybacks or subscription for drip dividends. Drip dividends. Yeah. Which they have done in the past. So even if there will be a spike in gearing above 42% gearing, some investors may not be comfortable with that. So you must take note of that. But I think that over time, they will still try to leverage down again. Yeah, that's all for me. Thank you.
In terms of the confusing rights, Natalie, can you just explain to everyone the difference, the preferential and the rights, the smaller discount, the renounceable part, just for clarity, for those who do not know what the difference, the preferential offer and the rights.
Sure. So for just give me 1 second. So for private placement, right? Private placement is for a selected group of investors. They could be new investors or existing investors, and whereas for preferential offering is for the term preferential. They is meant to denote existing shareholders, and because it's not all shareholders. Basically, for FCT's case, it's only shareholders that are have a registered Singapore address when you buy your share. So if you have purchased through CDP, then the CDP would have a registered Singapore local address. So then you will be entitled for the rights for the preferential offering. So the difference between the rights is because rights usually they are renounceable. Rights could be renounceable or not renounceable. So usually they are renounceable. So meaning that the right that the unit holder gets to subscribe for additional shares, that can be separated from the actual shares itself and sold off as a rights. That means they can be disconnected and sold separately. However, for preferential offering, they're usually non-renounceable in nature. Means that if you do, the only two actions you have would be either to subscribe for the new units, apply for the new your pro rata share of the units, or you just get diluted. So there is no way for you to actually separate this so-called right to subscribe for more units and sell it off in the secondary market. So that is one of the difference. And for a rights issue, which is in this case, FCT is actually offering a preferential offering and not rights issue. But because for rights issue, there's an unlimited percentage of discount that the company can issue the rights at. However, for a preferential offering, which is as this case is, the maximum discount to the VWAP will be 10%. So that's basically some of the differences between the preferential offering and a rights issue.
Yeah, the preferential is like a mini rights issue. Yeah. Okay. Is that all, Natalie? Anything else?
Yeah, that's all.
Okay. Let's move on to the next. I think Chun Rong, can you do before we, or Wei Ren, you want to there are some TA stuff you want to.
Maybe I take over here for now first. Okay, so there is a question that asks for target price for Netflix based on valuation and fundamental analysis. Okay, I understand that for the technical aspect, the target price is around 585. Okay, if you want to look at the valuation analysis, okay, you can probably, if you want, you can peg it to the forward P multiple. Currently, it's trading near its historical 2-year average. Okay, it's just at the average. But during this time when we are looking at a virus resurgence, Netflix will still continue to gain traction, considering that they are doing all this streaming and will tend to benefit if there is a further kind of lockdown. So if you give it roughly a 0.5 times of standard deviation of a premium above its current historical average, the target price is roughly 560. Okay, so 560, which is roughly in line with the TA side of around 585. Yeah. Okay, and I do see some other questions. Give me a moment while I look through it. Okay, there's one question which asks about Netflix. Will Disney be able to surpass Netflix? So in this case, I presume you are referring to Disney Plus, right? Okay, for now, in terms of the subscriber base, okay, if you just look at the subscriber base, Disney Plus as of 2Q 2020 is around 57 million. And for Netflix, it's 193 million. So in a way, in terms of scale itself, Netflix is already roughly 3 to 4 times larger than Disney Plus. But of course, Disney Plus came in later, right? And that's the point, because Netflix already has the first mover advantage in this streaming space. So they have already established a lot of regional partnership across the globe. So what I mean by this is that if you look at Netflix, their business model, right? They actually, they work with like smart TV companies. Sometimes your smart TV like LG and Sony, when you buy it, it already has a Netflix incorporated in it. And also, if you look at some gaming device like Wii, Xbox 360, PlayStation, okay, some of it already ingrained when you buy it. They already have this Netflix feature. So in terms of their international presence and content distribution, it is already there. Whereas for Disney, wise, they are still, of course, they are growing well, yes, but it's still, we still have to wait to see. But for this space, I believe that both Disney Plus and Netflix will be able to thrive together, because like I mentioned previously, it's not a zero-sum game, right? You can actually subscribe to both at reasonable pricing. Yeah. Okay, I think that's all for the questions for my part.
I have another question here as a follow-up question for FCT. So Ted has pointed out that he thinks that most of the shareholders are actually wondering whether or not it makes sense for them to subscribe for their full or partial preferential offering when the share price on the market now is so close to the offered price. So Ted, you mentioned what you pointed out is true. Currently, the market price is very close to the the prices for the preferential and the preferential and private placement prices. So I think the answer to this question would really depend on whether or not you would like to have an additional or higher allocation or the portfolio allocation to FCT. So before this transaction, our target price for FCT was actually $2.69. We raised it by 10 cents to $2.79. So of course, right now this is like a second chance. If you would still like to increase your stake in this accretive, in this very stable counter that has this inorganic growth that is going to kick in soon, then now will probably be a good time for you to get in lower. Because if let's say once the price rises back to $2.60, then you will have sort of missed the boat in that sense. So I think the answer to this question is really an allocation question. Do you like FCT enough to increase your sort of portfolio allocation to FCT? Yeah, and as of right now, like what you mentioned is correct. So there's actually no real difference whether or not you actually subscribe for it or not. And if you don't subscribe for it, it actually means that other people or other unit holders, you're actually allowed to subscribe for excess portion of it. So they might actually get your portion instead. So at the end of the day, it's whether or not you would like to get diluted if you care about that, or otherwise whether or not you'd like to increase your holdings in FCT. Yeah, hope that answers your question. Thank you.
Okay, I'll try to answer this question. Thank you for all your questions. Is it better to hold on to cash now or stay invested? So we think it's better to stay invested. A couple of reasons. Firstly, there's always something to worry. So there's always something to worry about the market. Even next year, one year time, you'll probably be worrying about something else. Probably that gives analysts a lot of work to do. But the main thing is that if you just look at the dividend yield of the STI, it's around 4% now. Whereas if you park in cash, you probably get 0.2%, 0.4%. So there's a big difference. And don't forget, this 4% basically comes from the banks. So let's say banks are now paying you roughly 3 point something or 4%, but they're paying you under very stressed conditions. They're paying you, they're still able to pay you 4% after entering a recession, number one. And then the government basically told them not to pay so much. So in a way, they are maybe 1/3 of their earnings is only paid out of dividends. Because if you take a 50% payout ratio, then they only can pay 60% of that. So only 1/3 of their earnings is really just paying out dividends. So you're getting 4% dividend yield under very stressed conditions, like the recession, and then authorities say don't pay anymore. So just purely on the dividend yield, you're getting quite a good spread. And thirdly, these dividends can grow, whereas if you park your money in cash, obviously you're going to be stuck with low interest rates. But of course, the flip side with cash is that you can be nimble. I mean, you can go in and out of the market, provided you can accurately do it. But again, no, so far this year, the STI is already down 20%. So from our point of view, it's quite rational and logical to be invested. Although you see that we don't have an overweight on banks, but because we have to take like 3 months, 6 months, if we take a 1 year view, it'll be like sometimes a bit too long for investors. So our views sometimes are a bit shorter, but in terms of longer term view, I think it's quite clear that banks will offer a better yield, because you can't get any yield in bonds or even deposits right now. So equities is, we think at least it's still a better way to can collect some yield. I hope that helps. Thanks. The next one, can you answer that? That one's US stocks. Mailing.
I think the question here states where to see the buy sell recommendation of US stock from Poem. Currently, we do not have a full list, but as and when we believe that some counters have potential or gain traction, then we will actually come up with trading notes. So in the meantime, probably you can look out for further trading notes. Yeah. And I think there is a question that says, what is the next likely black swan event? Okay, before the 3rd November US presidential election. Okay, I mean, black swan event, it means, in a way it's unpredictable, right? But for now, I believe that a potential one could probably be in terms of Trump's health. Okay, of course, if you look at Boris Johnson, it took like 3 weeks to recover from COVID, whereas for Trump, it took like, less than a week. Okay, so it can be dubious, but of course, we do not know whether, probably the treatment really works in that case, in his case. So, but for him, if under the event whereby his health start to deteriorate over the next few days, then definitely there will be a huge uncertainty, because the Republican may actually have to consider swapping out of the Republican candidate, because the US election is drawing near, right? So it will be largely dependent on his health. Okay, but for now we do not see this risk yet, because he's saying he's well. He's even going to Florida to gain some supporters vote. But this could be a potential black swan event in this case. Yeah. And there's a feedback also that says for TA question, probably can show the screen. Yeah. For when I was explaining the Netflix, yeah, I do mention on the TA portion. So sorry, I didn't manage to share it on the screen, but it's available in the trading note, which is on our stocks PNB. Yeah, so if you want, you can look out for it. I think that will be clearer in terms of the TA part. Okay, that's all from me.
Okay, I'll move on to the next. We'll just take another 3 to 4 more. With Singapore opening up more during 4th quarter 20, would Singapore stocks pick up much more compared to other countries, example US and Hong Kong? it's hard to do a relative. I think the issue we have in Singapore is that, in the US, they have a lot of tech stocks. So like Microsoft, I think this year is up like 30%. But JP Morgan is down, I think, almost 20%. But for us, Singapore, we are banking centric, right? So we end up picking up the JP Morgan performance. So that's why it's going to be tough for me to say whether they'll do better than US. But just purely on Singapore alone, I think with the further opening of fourth quarter, like we mentioned, we definitely clearly bottom, just that the pace of appreciation will be gradual. I think that's the best way I can answer it. Whether it can beat the US, I know Singapore doesn't have a Microsoft. We don't have tech heavy stock. If we have a lot of tech stocks, then we can at least we can kind of compete with the US. Yeah, but I guess the US, the banks also get hurt like us, but it's not so heavy on their index. Yeah. Hong Kong, I'm not very, very clear, sorry. I don't really know what's the index composition. The other one is tax ran a lot today. Any reason? I have no clue. I have really no idea, so I don't really follow them at all. And they don't really reach out to investors. So for us, it's like a black box. We're not really particularly sure. So sorry, can't really help you on that. I think there's one CCRT on TA.
CCRT, I'm not very sure which one do you mean. So if you can, do you mind you can drop because time constraint. I think do you mind you can drop a question.
I think it's CRCT is Capital Retail China Trust.
Okay, let me take a look.
We went Capital and Retail China Trust.
Do you know the stock code?
Unfortunately, no. Not on TradingView.
AU8U.
AU8U. Yes, this is the one. Okay, so yeah, it moved up a lot. First of all, because I think 3 weeks ago I did that. I did a stop on that. So the wedge pattern has very big form, but we are still it has break off the resistance level at 1.24. So we expect 1.32 to be next one to be tested. Most likely it will be broken, and then we have a forced breakout to 1.37. So this is the region that we'll be looking at 1.37 to 1.40. Okay, so I hope that answers your question. Otherwise, I think the upside, we do expect some pullback over at 1.32, a minor one, or if a deeper one, then 1.18, and that's a rebound thereafter. All right, thank you. Then next one is Sam Marine. I think Paul or Terence, you would like to answer that.
Okay, yeah, the question is it a good time to buy Sembcorp Marine now and outlook? My own view will be, I'm a bit worried myself. I mean, I don't look at the numbers specifically. I'm a bit worried they might need more money. I mean, that's my own concern. Again, I've not looked at the numbers and crunch it and everything, but the way the yards are performing, there's no business. There could be another round of capital raising because the last round didn't really inject much liquidity. They just converted the Sembcorp's loan into equity. So that doesn't really solve the liquidity issue. So that's my only concern. In terms of outlook, I think it'll be tough. I think the next 1 to 2 years, for me, I would rather just stay away until we see some light, rather than assume there's a light in 2 years' time and then go buy now. I mean, that's my own view again. But of course, there could be volatility. I think if oil price rise and move, then there could be people just trading it as an oil price proxy, I guess. The next question again, Sembcorp Marine. Any potential upside for Sembcorp in the next 1 to 2 years since the price has been declining? Yeah, I think we kind of indirectly warned of the rights issue. It'd be very damaging. I think, should we sell? I think maybe you might have to. Sorry, I'm just struggling to answer. The only thing is that probably a lot of Sembcorp industry shareholders really continue to have probably sold a lot. So maybe the share price might be depressed because there's a lot of Sembcorp industry minority shareholders that just probably just dump the shares. But for me, I think it will be still weak for the next 1 to 2 years. Yeah. I'm so sorry to answer this question. Maybe a technical can help, because I cannot tell you fundamentally it is really weak or quite bad. Yeah. Next time I'll move on. Any view on UMS and venture? I prefer UMS than venture. Although venture is done, the problem for venture is that it's such a black box. I do not know who are their major customers. I have really no clue, and very few. Apart from if you're an insider, you really have no clue which customers are doing well. So it's a bit a leap of faith for venture. But for UMS, I think that Applied Materials could be outsourcing more contracts. So I won't be surprised if they can even get more contracts, the way how buoyant the whole semiconductor cycle is, industry is, and the amount of projects that is coming out from China. So I mean, I won't be surprised if they maybe secure more projects.
Okay, so maybe I take last 3 questions for the technicals, and then after that I will just hand on the time to the rest of the colleagues. Okay, so let's look at DBS. So for time constraint, I'll just share on the DBS. I think OCBC and last check also have a very strong bullish upside. So last week I mentioned that, I think last webinar I mentioned that the chances that this resistance zone, this support term resistance zone will actually more likely to be broken after it has a sell down, but it didn't complete the sell down. Then now there is a prospect of it returning back to a $22 region. So in the short term wise, I think we are looking for 22 region, dollar region, and then breaking it, we'll see $23. So if you look at it, the upside is actually quite similar to the SDI. So with just that there will be W and X, and then we have W. There will be X, and then we have a Y wave over here on the upside at $25. Okay, so longer term, I think if $23 is going to be broken, then we will see $25 being the next move. All right, of course, further data will be needed. All right, but short term wise, we can see that price is going to test $22. All right, same thing. If DBS is going to move, I think OCBC and UOB is going to move as well. They move in tandem. All right. So the next question is second last question is ISDN. So Chris has actually asked ISDN. So ISDN is actually have a diamond shape pattern. So right now it's very neutral. Support level, I would say that is between 0.340 to 0.36 immediate support. And then the next support will be at 0.26 to 0.275. That will be the next support. Confluence is the immediate support over here. All right. So that's why it's the end. Then for Hang Seng Index, someone asked what is the correction percentage of what correction. So I think price is actually testing the resistance zone as we speak. As I mentioned earlier on, just now, if price is going to break on the upside, and then next level we test is 26,000. If 26,000 don't break, then we're seeing on the upside before a correction down. All right. So in between, there is a correction between. There will definitely be a short-term correction between 2,600 and then subsequently at 26792 as well. Okay. So with that, I end off my question. So I'll pass on my time to Natalie. Thank you.
I guess there's a question here about the developers given another 6 months to complete the project. However, the ABSD remains unsold for the units. Sorry. However, the ABSD remains. Yeah, this is correct. I guess this is a clarification. So even after the 6 months, the extending of the ABSD for another 6 months, if there are any units unsold by the time the ABSD date arrives, then yes, the whole entire project, be it sold or unsold units, will be subject to the ABSD. Yeah. That's all for me.
Yeah, okay, the next question is property supply normalized, demand heightened by, it normalizes to the average level. I wouldn't say it normalizes to maybe 2 years, it's back to the 3-year average levels. So, and one thing to note, one of the reasons why a lot of projects doing well is because the prices are quite disciplined prices. And what I mean discipline is just a nicer way of saying these are very low margin prices. So I think some of the developers are probably only hitting 10% or 15% margins. And always remember when I say 10-15%, just assuming you sell all the units. So you got like 10% more, then you probably your margin collapse maybe 5. I'm just putting a number, maybe 5-8%. So for Singapore-centric stocks, property stocks, I don't think the time is right yet. The margins are still very thin, and again, inventory is just back to normal. But we do have a buy on CapitaLand, I think, partly because they are doing well in China too, and it's also because they're growing fee income. So so that's the answer again. Pure Singapore developers, probably not the right time. Yeah. But what we're trying to say is maybe the worst is over, but it's still going to be low margins, and inventory is just back to normal levels. It's not like unusually low. There's not much pricing power for the developers. What's the difference between trading buy and trading? Chun Long, you want to help out on this? Because you got yours also trading.
Okay, the question here is what's the difference in trading buy, sell, and buy? I think okay, for the US side, what we say trading buy and sell is mainly more of a short-term kind of a period. So probably we are talking like maybe between 3 weeks or so. Yeah. So but in terms of a normal buy and sell, I think there's a 1 year time frame for that price. So yeah, I think it depends on whether it's on a fundamental approach or through a technical approach. Yeah. So in this case, if it's a trading buy for Netflix, in this case, then yeah, we give it like probably a 3 weeks shorter time frame for the price to materialize. So anything after that, then probably the technical thesis may not hold true. Yeah. Okay. And
yeah. Oh, sorry. Go ahead.
yeah, sorry. I just saw one more questions on JP Morgan, so maybe I'll address that. There was a question that say JP Morgan claimed that US stocks will tank significantly. My take on this is that ultimately it depends on the time frame that JP Morgan give, right? So when you say that US stocks will tank, like maybe before the US election or slightly after, okay, it is definitely possible. Okay, why? Because before US election, there could be still a lot of uncertainty. And especially when we are talking about a Biden win, okay, there could be a correction or a sell down in the market because people tend to perceive Biden as having more regulation and in terms of a higher corporate tax cut, which will eat into all your corporate profits and so. But ultimately, I believe that it is an overreaction in terms of the corporate tax increase. Because if you look at it, Biden is trying to use this tax increase to fund fiscal spending. You want to use this to propel in terms of clean energy and infrastructure. So in terms of all this, yes, it will take time to play out. Okay, but ultimately all this will flow back into the economy. So I would believe that there could be an overreaction in that sense. So yeah, that's my take on it.
Paul, do you want to take any one more
okay,
question?
I think we probably have to end it. Okay, let's take one last one. Can you help out on this housing loan thing? Okay, anyway, on VCOM, we don't cover VCOM. Good time to buy now, but I guess the business is very captive based on the amount of vehicles out there. So sorry, that's my short answer. The next one, is there a likelihood that the high unemployment rate will pull down the property market after we don't think so. I think even though the numbers are up, it's still very, very low. Of course, compared to history, we used to have like 2%, and now I think unemployment is about 3% plus, 3% plus. So we don't think that is that meaningful enough to dent. I think 3% is probably unheard of globally, which is probably still considered like full employment among the residents. We can one last one if you can. I'm not sure if you.
Okay, so for the last question is where with billions applying, okay, billions in value, I guess, for applying for loan moratorium, does it mean that once the support line is pulled out, there will be more default? No, of course not, because but the thing is that there is no precedence to this. People going on default for housing loans. So the fact that there are loan moratoriums on housing loans, of course, first of all, it is that housing loans are usually secured on the property, right? So in terms of risk itself, it will be lesser. But secondly is the fact that since there is no precedent, we do not know if it ever turns into a non-performing loan, what will be the extent of these non-performing loans formation. Yeah, so that's the main thing. So if it actually really happens, the fact that people can't pay off their housing loan, then there will be a very big, it'll be a very big red flag for the banking industry lah. But as of right now, because it is all secured, I think it's more of a bad thing for the economy. It really shows something that that people are unable to afford. Yeah, and it might not just affect the loans in the long term lah. Yes, but then generally in terms of the risk for the banks itself might be lesser because of the fact that it is a secured loan generally. Yeah, but it will be a worrying sign. Yeah, I think so. That's it from us. Thank you for joining us today. So with that, we will be ending the session. Yep. Thank you.